Anyone can leave generational wealth for their children and grandchildren. It doesn't matter how much you earn now. You only need to learn a simple financial trick Wall Street don't want you to know. We will put this trick to practice at the end of this video. Firstly, listen to Warren Buffett explain this very simple trick.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore, just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amount to, and it would come to $51 million now.
The S&P 500 index fund is the one to use. That's the one I used in that bet I made for 10 years. It's the one I've told the trustee for my wife to put 90% of the funds I leave her into. The S&P 500 is, I don't know whether it's 80% of the market value of everything you can buy in this country, and it's over. I think it's over 20 trillion. And you're buying America. And let me give you a figure that'll blow your mind. I think I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man!
Well, it's
okay.
But I just want your audience to think for a second.
Okay.
The answer is about $400,000.
Oh.
So if I, as a little kid, had taken that $114 I'd saved shoveling snow or whatever I'd done, $400,000 today, one person's lifetime. That's America. I mean, that isn't me. It is the huge tailwind the American economy gives to any equity investor. Now, the market's gone down many times during that time. People have panicked during that time. Headlines have been terrible. It looked like we were losing the war when we first bought it. But America is a powerful economic machine that since 1776 has worked, and it's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years, necessarily make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you: it will carry bigger fees than what I'm talking about.
You might still be wondering what the trick is. I'll explain it now. If you decide to invest $10,000 in the S&P 500 over the next 3 years and reinvest the dividends, in the next 60 years, your investment will be nothing less than $5 million. This will make your children and grandchildren financially independent and part of the top 5% of Americans financially. You might be wondering if this is still possible right now. Yes, it is. Warren Buffett explains why.
And there's no reason to think that we don't know if it's 400,000, but that same sort of process or returns won't happen starting right now.
The S&P 500 companies have earned well over 10% on equity, often 15% annually for years and years and years and years. They've done it with Democratic administrations, with Republican administrations. Now, you get money compounding at that kind of rate underlying your investment, and you get a diversified group of that. I mean, you're going to do well.
Before putting this investment advice to practice, listen to Warren Buffett and Charlie Munger explain how you should structure your investment in the S&P 500.
So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over, a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Warren Buffett just explained the concept known as dollar cost averaging. It is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. The purchases occur regardless of the asset's price and at regular intervals. For example, if you want to invest $1,000 in the S&P 500, you can split your investment into $200 every month, and you invest for 5 months. Let's put this financial trick to practice. Assuming you want to leave generational wealth for your grandchildren in the next 60 years, you can plan to invest $20,000 in the S&P 500. You should invest $350 every month for the next 5 years. This is known as dollar cost averaging. The S&P 500 serves as a hedge against volatility and risk of investing in individual companies, and you are also making a bet on the prosperity of American companies, which is a safe bet. In the next 55 years, your investment will be in the millions based on the performance on the S&P 500 in the past. A lot of people do not follow this advice of Warren Buffett and Charlie Munger.
Under the conditions you name, I'd probably have it all in a very low-cost index fund, and it'd probably be, might be Vanguard. Somebody I knew was reliable, somebody where the cost was low, and because you postulated that you're not going to become a professional investor, I would recognize the fact that I'm an amateur investor, and I would feel that unless bought during a strong bull market, which this hasn't been, I would feel that that was going to outperform to a degree bonds under current conditions over a long period of time, and then I'd forget it and go back to work. Yeah, and that you will not get that advice from anybody because nobody gets paid to give you that advice.
If you decide to invest in individual companies instead, listen to Charlie Munger explain how to beat the market.
We have to deal in things that we're capable of understanding, and then once we're over that filter, we have to have a business with some intrinsic characteristics that give it a durable competitive advantage. And then, of course, we would vastly prefer a management in place with a lot of integrity and talent. And finally, no matter how wonderful it is, it's not worth an infinite price. So we have to have a price that makes sense and gives a margin of safety considering the natural vicissitudes of life. That's a very simple set of ideas. And the reason that our ideas have not spread faster is they're too simple.
To learn more on how to beat the market, you can watch our previous video on how to beat the stock market like Warren Buffett. See you in the next one.